Guide. Understanding risk management in finance and mitigating financial risks. Introduction. Risk management in finance is a crucial process for identifying, assessing, and mitigating potential risks that could impact the financial health and stability of individuals, businesses, and organizations. By implementing effective risk management strategies, individuals and entities can minimize the likelihood of financial losses and protect their assets and investments. In this guide, we'll explore what risk management in finance entails and how to mitigate financial risks effectively. 1. Understanding risk management. Risk management involves the identification, assessment, and prioritization of risks followed by the application of resources to minimize, control, and monitor the impact of these risks. In finance, risks can arise from various sources such as market volatility, credit default, liquidity constraints, operational failures, regulatory changes, and geopolitical events. 2. Types of financial risks. Financial risks can be categorized into different types, including market risk, credit risk, liquidity risk, operational risk, and regulatory risk. Market risk refers to the potential losses arising from changes in market prices or conditions. Credit risk pertains to the risk of default by borrowers or counterparties. Liquidity risk involves the inability to meet financial obligations due to a lack of cash or marketable assets. Operational risk encompasses risks associated with internal processes, systems, and human error. Regulatory risk relates to changes in laws, regulations, or compliance requirements that could impact financial operations. 3. Mitigating financial risks. A. Diversification. Diversification involves spreading investments across different asset classes, sectors, industries, and geographic regions to reduce exposure to specific risks. By diversifying their investment portfolios, individuals and organizations can minimize the impact of adverse events affecting any single asset or market segment. B. Risk assessment and monitoring. Conduct regular risk assessments to identify and evaluate potential financial risks across various areas of operation. Develop risk management frameworks, policies, and procedures to address identified risks effectively. Implement robust monitoring and reporting mechanisms to track risk exposure, assess control effectiveness, and respond promptly to emerging risks. C. Hedging strategies. Utilize hedging strategies such as derivatives, options, futures, and insurance contracts to mitigate specific financial risks. Hedging allows individuals and organizations to protect against adverse price movements, interest rate fluctuations, currency volatility, or other market uncertainties by transferring risk to counterparties or insurance providers. D. Stress testing and scenario analysis. Conduct stress testing and scenario analysis to evaluate the resilience of financial portfolios and systems under adverse market conditions or extreme scenarios. Simulate potential risk scenarios, such as market crashes, economic downturns, or geopolitical crises, to assess the impact on financial performance and identify mitigation strategies. E. Compliance and risk governance. Ensure compliance with regulatory requirements and risk governance standards to mitigate regulatory and operational risks. Establish robust internal controls, compliance procedures, and risk management frameworks to promote transparency, accountability, and integrity in financial operations. Regularly review and update risk management practices to adapt to evolving regulatory environments and industry best practices. F. Contingency planning. Develop contingency plans and business continuity strategies to mitigate the impact of unforeseen events or disruptions on financial operations. Identify potential risks, vulnerabilities, and dependencies within the organization, and develop contingency measures, fallback procedures, and crisis management protocols to maintain business continuity and resilience in times of crisis. G. Continuous learning and improvement. Foster a culture of continuous learning, innovation, and improvement in risk management practices. Encourage collaboration, knowledge sharing, and interdisciplinary approaches to risk identification, analysis, and mitigation. Stay informed about emerging risks, market trends, and industry developments to proactively adapt and respond to changing risk landscapes. Conclusion. Risk management in finance is essential for safeguarding individuals, businesses, and organizations against potential financial losses and disruptions. By understanding the types of financial risks, implementing effective risk management strategies, and embracing a proactive and disciplined approach to risk mitigation, individuals and entities can enhance their financial resilience, protect their assets, and achieve their long-term financial goals. Embrace risk management as a strategic imperative and invest in robust risk management practices to navigate uncertainties, capitalize on opportunities, and thrive in an ever-changing financial landscape.